Hey, we got to talk a little bit about the markets this past week. The U.S. government selling 30-year bonds at the highest interest rate in about a quarter of a century, coming just days after an equally impressive 10-year auction. Yeah, we got to, pay for that debt and all that good stuff. Long-term yields, though, you felt it surging past 5% this year. Investors are starting to wonder if the Fed will be forced to keep interest rates elevated for years to come. Joining us now to discuss it all is PNC Chief Investment Officer Amanda Agati, joining Joe and me. Amanda, good to have you here on the weekend. A lot of things to go. When you think about the week, we've been spending a lot of time talking about the U.S. war in Iran. There's a lot of things that continue to come at investors. What's top of mind for you? Is it the auctions? Is it what the Fed does as we get ready for minutes next week? What is it?
Well, it's great to be with you both. Thanks so much for having me. I think the thing that's top of mind for me is really the impressive resilience in both the underlying earnings growth backdrop as well as the economic growth backdrop. There's still a lot of purple haze swirling around, but it seems as if the market and investors are largely focused on the fundamentals, which is a healthy thing. And for Q2 earnings season to come in at such an impressive upside surprise, 50% earnings growth year over year, not a typo, right? I think it speaks volumes about the strength of the underlying market at these levels, even at these valuation levels. And it sets the stage for a pretty strong second half too. So I'm focused on the fundamentals, trying to dial down the noise, as it were, from all that purple haze.
Well, geez, I don't know if it's purple haze or manic depression, Amanda, the way the market's been acting lately. Everybody is kind of worried about a real correction happening, a real 10% decline in the S&P 500, which just finished its third straight week higher. We had that whole situational awareness freak out, the momentum stocks.
They're buying again, though.
But they're all almost back up to where they were, Amanda. Do we still need to correct?
It's a great question, and you threw out a lot of technical terms, right? Manic depression, right? Freak out, frenzy.
Yes.
There's been a lot of that. Investor sentiment and investor psyche has been through the ringer on a year-to-date basis. And again, it goes back to all this purple haze, right? How do we price all the uncertainty that's coming from the purple haze? I don't think we necessarily need a correction. Corrections, for what it's worth, tend to be signals of a very healthy, functioning market. Not that I'm wishing for a correction necessarily, but we are starting to break some records again for how long we've gone with pretty low volatility and without a meaningful market correction. I think the second half of the year is a pretty strong setup, as I said, from a fundamental perspective. I would not underappreciate the volatility that may come leading into the midterm. So that could create a little bit of noise. It could create a little bit of a correction or a downdraft. We'd be using it as an opportunity to reposition portfolios for sure.
Morgan Stanley's Mike Wilson sees earnings reviving momentum trade. You've got that view. We, though, did some reporting, too, that we have had such strong earnings. It's going to be really tough comparisons, and that momentum cannot continue, or is not at least expected to. So that's a different set of fundamentals. Does there need to be potentially a reprice off of that?
I don't think there needs to be a reprice per se. I mean, I would say for the record, we've had a little bit of repricing since the beginning of the year. Earnings growth has been so strong that the E has been outpacing the P in forward PE multiples. So we're trading at a more, reasonable, I guess is a relative term, but more reasonable PE today than we were at the beginning of the year. That said, the market is not cheap, of course. I mean, we get that. There are still pockets of opportunity. It looks like for Q3 earnings season, it will be the fifth quarter in a row where we have been seeing a trend of positive revisions, setting an ever higher bar and then hopefully beating it. But you're right to call out that this momentum can't last forever and that comparisons do get tougher from here. And so, maybe 2026 is peak earnings. I don't want to get bearish with you. I feel very good about where we are right now, but it does look as if the setup for 2027, I guess it is pretty early, but for 2027, that year over year earnings growth is going to slow. It's hard to argue that mid-teens is really, a market moving event, though. There's still a decent amount of strength, even if we get to that level next year, too.
Carol started us off by talking about interest rates. I don't know how you're feeling about this, Amanda. 5.25 on the 30, 4.69 on the 10. A lot of economists are telling us that a 5% on the 10-year is inevitable. Is that what brings the rally to an end?
It's such a great question. We've been getting this question a lot lately. There's no question that hitting a 5% level is a psychological threshold, barrier, headwind to markets. But I think, in past cycles, we've seen that historical relationship be very strong, that correlation of once you hit that level, equity markets start to struggle. I don't want to say dangerous words, it's different this time, but it feels like that relationship is breaking down a little bit, if for no other reason than the backdrop just continues to be so strong. I think there are other fundamental drivers for why rates are market-based rates without, Fed doing anything, are moving higher. Certainly, the inflation backdrop is warm, maybe not hot, but it is certainly warm. The risk premium at the long end is certainly moving higher. I think that's driving the 30-year, certainly. I think duration risk is pretty significant in this environment. So you have to entice investors to go long here. But again, I think the deficits and debt level situation are more what's driving this as opposed to kind of historical relationships. It matters this time. It matters in this market cycle as opposed to past market cycles. But I don't think it's a foregone conclusion that the equity market starts to falter here.
Hey, Amanda, you mentioned the Fed. We've got minutes coming from the last Fed meeting, the FOMC minutes. They're going to be released this coming Wednesday in an environment where we've got a Fed chair, Kevin Warsh, who certainly wants to communicate differently, at least so far. What are you looking out for? It feels like the minutes take on kind of a higher value, if you will, in this environment, new Fed environment.
Well, there's no question he wants to take a different approach. For what it's worth, I think that's actually healthy. For years and years, we've been fixated on what color tie the Fed chair is wearing, right? How he shifts in his stance at the press conference to try and figure out what the path forward is likely to be. So I would love to see the Fed get out of the driver's seat as it relates to, how the equity market in particular moves from here. I think the reality is the more they pull back, though, in the short run, it's just going to create some noise and volatility. So, we know the Fed is very much divided in terms of the path forward here. It's hard to make a call. But based on the data that we're looking at, we do not believe that they should be hiking in this environment, that some of what is happening here, again, dangerous word, transitory, right? That word didn't work out so well the last time. So maybe I'll say temporary. But we just don't see the Fed needing to make a big move in September.